Good evening, ladies and gentlemen. This is Barry Norman on behalf of VTX, and welcome to our webinar on building an effective trading plan. Now, for those of you that are joining us for the first time, ETX is a regulated provider, and I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading in the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risks or seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only. Now, for those of you that don't know much about ETX, we're a fast-growing financial services company based in London. We are authorized by and regulated by the FCA, and we're also a member firm of the London Stock Exchange. When you trade with ETX, you have many choices. And if you're not sure about all that they are, from our Trader Pro platform to our MT4 platform, just contact customer support and they'll get you set up in any one of them, all of them, whatever you'd like. We'll make sure it happens for you. And also, if you've been trading with us for a while, make sure you try out our new ETX Trader Pro platform. Just go to the top of your trading platform. Excuse me, when you log in and click on that says new platform, you can go back and forth. If you want to go back to the old platform, just click on the button to go back to the old platform. But the new platform is one of the most dynamic and fast execution platforms in the marketplace, with about the best charts that you can possibly use. Now, tonight's class is being recorded, and to see a recorded version of this class, just use the same link you used to come to tonight's class in about 24 hours. So let's talk about building the plan, the trading plan. And I'm sure we have a lot of people in class tonight, and I'm almost positively sure that very few of you have an actual trading plan. And a trading plan is much more important than a trading strategy. In order to become a successful trader, you need to develop a written trading plan. Yes, written. Of course, that means you can do it on a computer, but you need to have a set of written rules. Basically, a trading plan is your trading Bible. No, it's not your strategy. No, it's not your exit and entry points. It's a lot more inclusive than that. There is no such thing as an ultimate trading plan because there are no two exactly the same traders. And every trade has a different trading style, strategy, risk tolerance levels, and market experience. It is always better to develop one's own personalized trading plan and modify it as your experience grows. Now, every time I give this class, people say, can you send me a copy of a trading plan? Can you send me your trading plan? Can you give me an example of a trading plan? But the fact is, there is none. Okay. A trading plan is a journal, a book, an Excel spreadsheet that covers every decision you're going to make about your trading. Okay. From how many times a day you're willing to trade, to the hours you're going to trade, to what decisions you'll make, how you'll make them, how you'll analyze your effectiveness. So remember, a trading plan should be thought of as a template for trading the markets, not for making a trade, not for what you're going to do today. It is your guide, and it doesn't cover just a day. It covers a week, a month. It covers how often you're going to analyze your success and failure ratios. When are you going to change your strategies? When are you going to go back and look and see if you're making smart trades? This checklist will contain each aspect of making a trade in a logical step-by-step sequence that acts as your objective guide to trading the markets. In essence, a trading plan will state your overall and long-term goals as a trader and will provide you with a clear checklist of how to achieve them. Now, unfortunately today, online trading is very easy. You use it, set up a username and a password, you do out some verification forms, you put some money in an account, and you're off and trading. But if you stop to think that this is a business, and if you were going to open a retail store, a restaurant, any type of business, you would sit down and spend weeks building a marketing plan, building a business plan, building everything, putting all the possibilities, putting together budgets and analysis. Because hopefully you're going to go to the bank and borrow some money, and they're going to want to look at what your plan is. When you open your store, you need to know how many footfalls you can have, how many employees you have to have. If you're going to open a restaurant, how many napkins you need to order. You're not just going to open up a restaurant and just expect the world to come to your door. How do you know if you're going to have too much food in the freezers or not enough? So in order to build your own trading plan, you should put into it what trading strategies you're going to trade. Not one, all of the different strategies that you use. What currency pairs you're going to trade. What your daily routine will be. So the question is, where do I start? And the fact is, you start from the beginning. And your trading plan doesn't have to be long. It's something that you will keep adding on to. As most of you know, I've been trading for 40 years, and my trading plan is rather extensive. And I have lots of personal rules, personal ways I do analysis, personal decisions I make. You'd be surprised. Your trading plan contains the days you'll trade, when you walk away from the markets, when you'll take holiday. Sometimes it's very good just to say the 15th, 16th, and 17th of the month, I'm not going to trade. So you should begin your trading plan with your trading strategies, because that's where you start from. Look, you spent all this time learning how to trade. You've built a couple strategies. You've decided some ways that you want to enter and exit the markets. Okay, so the easiest thing is to throw that into your first plan. But then you should put them first. This will act as a blueprint for what you need to do each time you interact with the markets. You firstly need to backtest all of your strategies in order to find out whether they have positive expectancy or simply put making money or not. In addition to your strategies, you need to put in your risk tolerance and your money management rules. Because if you build this into your trading plan, guess what? You'll start leaving that emotion at the door. Because if part of your trading plan says, okay, when this strategy tells me to do this and this, I'm only going to risk so much money, so my profit loss ratio has to be this, this, and this. And guess what? When you follow those steps, you may say, you know what? I can't make this trade because it's too risky. Having written strategies with your own risk tolerance and money management is like having a market blueprint. This blueprint is essential for developing the discipline that will lead you to the road of success. If you find yourself not following the rules of your trading plan, then you know what you are deviating from your plan. So the next thing it should state is what instrument you are trading. And this is critically important, because another problem we see is because of the ease of access of all the markets with online trading. Too many traders trade too many assets. You can't be an expert on every asset, and you can't be trading and watching them all. And more than a handful, you don't have the time to do the proper analysis. So first you have to decide what assets you'll be focusing on. So for example, the euro US dollar or the pound US dollar, and make sure you state this in your plan. Then you need to have a routine in your trading activities. And this is very important. In your pre-market phase, you will write all you were willing to go to from waking up to what you do before sitting to trade at your desktop. Now, this doesn't make a difference whether you're doing trading part-time or trading full-time. Okay. Like I get up in the morning, 5:30 every day. I check a couple things before having nothing to do with the markets, and then I go look at my charts for the markets. I go look and see what happened overnight. I don't look at news, I just look at the charts. I then look at my economics calendar for the day. I then look at the news headlines outside of the economic market, see who's been going crazy, Donald Trump or North Korea. And this is how I mentally prepare myself for the day. You can prepare yourself whichever way you want, because you may not be starting to trade until 6, 7, 8 o'clock when you get home from work. Or maybe you trade on your lunch hour. Whatever it is, you have to have it in a regular plan, in a diary. So during your trading phase, you would follow your checklist. This is crucial in order to put yourself in high probability trading opportunities. And this is one of the things that is so important, because you only want to make the most highly probable trades that you can make. Making a trade is going to make you a couple pips, and overlooking a trade is going to make you 50 pips. It's stupid. So when you're not spending the right time doing the right analysis, you end up wasting your time on this few pips and missing out a trade that you could have made a lot. So this will include things like you look in the market and what you see before entering a trade. In your post-market phase, your main activity will be record keeping your trades. A trading journal is all important because it allows you to analyze your trades and find out whether you are following the trading plan or not. And having aftermarket follow-up is so important. Too many traders, they just keep on trading, keep on trading. They don't have any journal. I can show you every trade I've ever made in 40 years. And you need to write down the results from each trade. Write your analysis, why it was successful, why it failed, what you would adjust to the strategy the next time, what you might have done better, what you might have done worse, and your notes so that you can test it, retest it, come back and reread it again. And when that certain trade presents itself a year from now, you can go back and say, look at that. I remember trading the euro doing the same thing based on the same chart patterns, and look and see exactly what happened. Make sure you maintain a trading journal which has logs of all of your trades. This is important because it allows you to analyze your trades at the success of your plan adopted by you. It should include the entry date, the entry price, the exit price, stop and limit, total profit and loss, and final notes, which are your personal notes on each trade. Your daily routines are crucial when trading success, because based on them, we build a ritual that help us maintain a high level of focus at a state where we perform at our best level. All top athletes and sportsmen go through their own ritual in order to perform at their best level. Your trading plan should contain a written description of what you would do in the markets. This includes things like what is your trading edge, how you trade it, when you trade it, what time frames do you trade, okay, your risk strategy for money management and profit taking, how you're going to set your stop loss, what execution and exits, what type of trades, what order entries you're going to make. So I use the word stick-to-itiveness. It's not really a word, or is it? But it means coming up with a plan and sticking to it. And this is what becomes very important. If you find that you build this plan and can stick with it, doesn't mean you can't modify it and change it. But modify and change doesn't mean, you know what, I see this great trade, I'm going to make it right now. No, it means going back into your plan and writing a change to your plan. You'll find that you will be more successful in the long run. The creation of a trading plan is highly useful as it reduces the possibility of bad or irrational decisions based on emotion. If you have a written trading plan, then you have a trading filter that will filter only high probability trading opportunities. It is important to have a written plan because in order to keep a high level of discipline, you should read it every day. The key to discipline and objective forex trading is to establish a trading plan where you put all the necessary rules and stick to it. So let's talk about some important elements that you need to add into your trading plan. Because I don't really care about what strategies you're using, how you're going to make your trade, what's going to give you your entry, your exit point, what's going to signal a trade. That's all part of strategies that you're welcome to come up with and do all on your own and figure out yourself. It's including those strategies within your trading plan. But if you ask 100 traders if they can send you a copy of their trading plan, I guarantee you it will be the highest rejection level event of your life. Unlike business owners who generally have a business plan in order to provide a strategic vision to employees and to stay focused on their primary line of business, most traders never take the time to create a business or trading plan. There are already 1 million articles on the web about trading plans. But what separates this article or tonight's class from the rest is I'm going to show you how to create a trading plan in less than 10 minutes by answering a series of simple questions. Number one, how many trades will you use to evaluate your performance? And I bet you didn't think that the first thing we're going to talk about is evaluating your performance. Most traders never do this. They'll look at how much profit they made. They'll look at how much money they have in their account, but they won't ever actually evaluate. And they don't want to say to themselves, well, yes, I made money, but I didn't follow my plan. In most lines of business, time is the main driver for evaluating performance. Companies report on a quarterly basis to the street, which fundamental analysis then feverishly work through the data to assess a company's future. Well, how long should you wait to evaluate your trading performance? Yearly, monthly, daily? The answer to this question is very simple. Base your evaluation period on the number of trades placed, not the amount of time passed. And this is very important because some people trade a lot and some people trade a little bit. So you shouldn't be saying, okay, every week I'm going to do analysis. I stop everything I'm doing after every 10 trades. And I do not enter another trade until I've done a full analysis on those 10. Because believe me, you're not going to miss any opportunities. The market has more opportunities than you'll ever be able to deal with. So stopping doing the analysis isn't going to cost you money. So time is irrelevant in the world of trading. Trading is one few areas in this realm where the space-time continuum is of no relevance. Those of us that have been trading for some time know that 1 year's stellar trading performance can lead to a 2-month binge of destruction, which can easily eradicate everything you've been working hard to create. The way to answer the tracking of your performance is to create a set number of trades that you will evaluate against key performance metrics, which we will touch upon next. But you need to identify the right number of trades for you to evaluate. But this number needs to be high enough that you have a decent sample set, but low enough which prevents you from going on a destructive trading edge. For me, the number is 10 trades. This applies to both my swing trading and my day trading activity. On average, it will take me approximately 3 months to place 10 swing trades and about 4 days to place about 4 day trades. I only mention the time element so you can see how long it takes for me to place the number of trades based on my trading style, because I don't trade that much. That doesn't mean I'm not in the markets. I only place very high opportunistic trades, and I do a huge amount of technical and fundamental analysis before I trade. Too many people want to get online and push buttons and trade. If you look at my demo account for this class, I got more demo trades for just teaching class than I actually have trades that I've actually made to test the markets. Now, if you're evaluating or testing a strategy, you should be doing that on a demo account, and you could be making lots of trades because you want to see how that strategy works in all types of environments. But once you're trading, or whenever you're trading in a real money account, you need to be careful. You need to ask yourself, okay, so what is the number of trades you will use when evaluating your trading activity? 2, what are the performance metrics that you want to keep in mind? And I use keep it simple, stupid, the KISS attitude. Okay. Means I only care about 2 metrics. One is R. This is the ratio of your profitable trades divided by your losing trades. I want to see how many not how many dollars I made. Okay. How many winners to how many losers. Okay. And I also want to use this to adjust my maximum drawdowns. Okay. This helps me restrict how much money I have in the market at any given time. Okay. Because you can say, okay, I'm only going to have a couple trades going on, but you can end up having a lot of money in the marketplace. Okay. So you want to always be sure how much your maximum drawdown is. The next is, what was my return on my investment? And my R, my percent R, my winners to my losers, I want to keep evaluating that. I don't care that it's 53% or 62% because I'm using the same money management rules. Okay, I want to care that each month I stay at 62%. I don't want to see that one month I fell all the way down to 38% because I can have winners to losers and still have made money. But if I'm picking more losers than I am winners, I got a problem. So then number 3 is, what time of day will I trade? For my day traders, I highly recommend you limit your trading activity. For me, I only trade from 9:50 a.m. to 12 noon. Any trade activity occur before that or after the zone, I'm purely a spectator and on the sidelines. And this is a very good thing because it will make you sit out of the market. It'll say, guess what? I have time on my hands. Let's go do some proper chart analysis. Let's go back test some more strategies. Let's go over and trade in a demo account for a while because you've limited your actual trading time. And this is a hard thing to do. It's a very difficult step. Then 4, you want to define your trading edge. Trading edge is similar to trading strategy. Similar to the time of day that you trade, keep your trading edge down to 1 or 2 setups when starting out. The more strategies you hope to master, the more difficult it will become to consistently make money in the markets. Below are details of my trading edge. Early range breakouts, high volume, tight spreads, consolidate before the breakout. Only enter a position between 9:50 and 10:10. That's it. If you feel your list is bubbling with over 20 criteria, you will drive yourself crazy trying to respect all of the rules. I'm a firm believer. Trend lines, support and resistance, breakouts, and volume. That's it. All you need is something that's going to tell you that an asset is going to have some momentum to move in your direction. Then you're going to let your money management and risk management take over. So develop a standard methodology for identifying plays. You will have to first ask yourself a question. What is my time horizon for this trade? Now, most of us are, by default, day traders. You will want to focus on events in the news, while long-term traders want to focus on securities that are developing new growth or business that show the potential for multi-year growth. Whatever your trading style, make sure I identify the plays that have the highest odds of probability. For day traders, you want to focus on market movers. This provides you the greatest opportunity for locating stocks or assets that are trending hard with high liquidity. So if you've limited yourself to, say, 6 assets, it's really fast to see which one of them today are moving. Because without an asset having volatility, and if it's chopping and range trading, it's not going to offer you any opportunity. So go over to the ones that in your list of your 6 that are. So, and then establish your goals. Goals are very important. Short-term trading goals to make consistent profit each month and supplement the monthly income from your job. To be patient and disciplined trader who follows my trading plan. Those are very important goals. For long-term trading goals, to build my trading account up to $25,000 through mastery of trading strategy, patience, and discipline to follow my trading plan each time I trade. 3, to avoid overtrading, be patient, remain disciplined, and get to my plan always. A goal without a plan is just a wish. Now, your trading strategy. Okay, analyze the market conditions. Is the market trending or consolidating? You need to first determine what condition the market is in. I teach traders how to identify trending and consolidating markets in my trading course. But basically, you just need to identify the general direction of market is moving and try to trade with that direction. Now remember, we had a class last week in trend trading. Okay. Trend trading is one of the easiest ways, or momentum trading. Okay. We are looking for higher highs and higher lows in an uptrend and lower lows and lower lows in downtrends. Also, I teach you how to use the daily 8 and 21 EMAs to identify near-term market momentum. For consolidating markets, we are looking for a market that is consolidating between an obvious support and resistance level. So then the next thing you want to do is part of our trading plan. We want to determine the core daily support and resistance levels. Keep them on a chart. So we've got our 6 assets. We've got our basic strategy. We've got our chart set up. And what are we going to do? Before we get our day ready for trading, we're going to start doing some basics. Like I told you, trend line, support and resistance line. Put those on your charts, okay? Regardless of whether you're going to find a trade there or not. So after you determine whether the market is trending up or down or consolidating sideways, you need to draw in the core support and resistance levels on your chart. These are going to be confluent value areas that you watch for price action strategies to form near to trade back in the direction of the dominant momentum. Look for price action signals that have formed at confluent levels in the market. Make sure to trade only very obvious confluent setups. Now, we come to the more technical end of placing a trade. And this is determining where to put your stop losses. Now, you've done your risk management. You know how much money you're willing to risk. You've already determined the market volatility. But stop losses are not a negative thing. Stop losses will keep you in business over the long haul. My stop loss is once the position goes against me 2%, I'm out of the market. The 2% threshold is based on the volatility of the asset I trade and may not be suitable to all trading styles. The point here is just to make sure you have a stop loss. If you find your stop loss is consistently being hit, then you need to take a deeper look at the volatility of the asset you're trading. Now, there are many different strategies for stop losses, and this should be your trading plan. Like I firmly follow, if my asset is moving in my favor, I'm using a trailing stop loss, but as soon as that asset moves into profit for me, I move my stop loss all the way up to a break-even point. Okay. I also sell half of my trade. That way I've already booked profit. As if the asset moves further in my favor, I don't care if I get stopped out. Okay. What's important is that I've already locked in profit, but it's important to have some type of an exit, a stop loss strategy before an exit plan, because you need to know what you're going to do as that asset moves. How are you going to take your profit? You're not going to sit there and too many people open a trade, put my stop loss here, my take profit point here, my order entry here, and then go off and go shopping. And they think, the trade's going to trigger, it's going to do all this. No. When you're in the market, you're in the market. And that's why you limit the hours that you're going to trade, because those are the hours that you're going to be part of the market and you're not going to be taking your eyes off the ball. At 7, you want to decide when to exit. You have heard all the market wizards say, let your winners run. Well, once you figure out what that means, please let me know. The greed in you will prevent you from closing your winning trades, even after you hear that little voice in your head tell you the run has come to an end. The way to avoid this scenario is to have a clear exit strategy. Again, keep it simple. The exit strategy should be as simple as when the asset crosses below a moving average, or that an indicator moves into an overbought or oversold territory. Whatever it is, define it in your plan and get out of the market when it tells you to. For some reason, traders have fooled themselves into thinking that successful trading often boils down to the latest algorithm or technical indicator. This could be the furthest thing from the truth. When you are trading, you may forget that there are human beings at the other end of the buy and sell transaction. This is a head-to-head competition to see who is right, the bulls or the bears. Part of the game of trading is not to reveal your hand. The smart money will consistently force sharp moves up and down in order to throw off the little guy before the big move. You are probably asking yourself, what does a positive attitude have to do with all this? Well, everyone may have stop loss orders, technical indicators, charts, access to news, etc. There are some traders who are able to translate all this information into successful trading or money and profit. So the success factor, my friend, begins and ends with a winning attitude. Think about it. When you see your asset have a short hiccup in a current uptrend, is your first reaction to sell and lock in your profit? Or do you move your stop up so quickly that you're basically begging the market maker to trigger your order? The winning trader will see the same price movement as you. However, he or she will not interpret this information negatively. They will see a slight pullback in an uptrend as a healthy price action and will comfortably watch the chart move without a negative emotion in their body. Their ability to sit through these corrections does not mean they have a lack of money management principles. It just means they believe the market will go in their favor as long as the correction or counter move does not damage the overall trend. Now we come to number 8, which is very important. How much money can I use per trade? Now, of course, this depends on how much money you have, how much knowledge you have, what your risk tolerance is. But without money management, you will not stand a chance of making it in the business of trading. For me, the amount of capital I use per trade largely depends on how well I am performing. If I'm going through a rough patch and my key performance indicators are down, then I use less money to minimize the damage to my account. However, for keeping it simple in this article, I only use 10% of my available day trading buying power per trade. For example, if I have $250,000 in cash, this would translate into $1 million in day trading power. Hence, I would use no more than $100,000 per trade. But this is a large account if you're using a small account. But remember, you don't want to ever have one trade that can wipe out your account. Now, as I mentioned earlier to you, it's very important when to take breaks. This is something you will not see in other trading plans on the web. when you will take a break from trading. Sounds like a no-brainer, but you will be surprised how many traders I talk to that never take breaks. Whether the trader has just had his best series of trades or has an all-out massacre of their entire account, the vast majority of traders just keep on placing trades day after day. I take a break after I place 100 trades. I will take a day off just to give myself time to relax and reflect on my activity. It doesn't mean, even if this is part-time and you got a job, doesn't mean you're taking a day on holiday. It means you're taking a day off from the markets. You're not going to look at charts. You're not going to go online. You're not going to look at you're going to do nothing involving your trading account. You could be asking yourself, couldn't I just take a break over the weekend or on federal holidays? Very true, but taking a self-imposed break goes back to discipline and exercising your control over the markets. See, when you do this and you said, I'm taking a break, you're in control. Well, the market is always there. I don't always have to respond to her every move. And lastly, we want to always keep track of limit ups and limit downs. The major exchange and prop firms think in terms of limit up and limit down. This concept of curves was originally created in about 1987 after the crash. Okay. For me, if I lose 2% of my trading capital at any point in the day, I need to exit all positions and go fishing, even if I have positive positions. It just says, I'm having a bad day. Let's get out of the markets. Conversely, if I make more than 7.5% in my trading portfolio one day, I do the same thing. I said, I've had a great day. I'm not giving it back to the market. And close out your trades and take the rest of the day off. Remember, you're the one who's in control. So think about limit ups and limit downs. Now, here's a starting point. Okay, how many trades will I use to measure my performance? What time of day can I enter new trades? At what time of day must I close all positions? How much will I risk per trade? How much money will I use per trade? How will I find assets to trade? What strategies or what edges will I use? How will I measure my performance? How many trades will I place before I take a break? And those are just the bare beginnings. But think about it, and the more effort you find you put into this, you'll find that you'll be more successful, but you'll spend more time thinking about trading, making the right decisions than actually making trades. And when you make only high probability trades, because you've done the proper evaluation, you'll find out in a long term, you'll make less trades, found more enjoyment out of making those trades, understand what you're doing better, and find that you stay in the markets a lot longer and more successfully. So on that note, I'm going to say goodnight to everybody. Thank you very much. And again, you can see a recording of this in about 24 hours by just using the same link that you used to come to tonight's class. So if you missed something or didn't see something, just use the recorded version. Thank you very much, and thank you for being part of ETX. Have a good night now. Bye.